This is Colin O'Keefe for LXBN TV. It's gone somewhat under the radar in comparison to other issues, but the student loan crisis has reached, quote, bubble bursting levels. Joining me today to explain how bad it is and what it means for the future is Douglas Bates of Berger Singerman and their blog, the Business Reorganization Report. Doug, first off, just how bad is the state of student loans? Can you give us some figures on just how bad the debt is?
Sure, thank you, Colin. There are two ways to define how bad it is that stand out, and we've blogged about it at the Business Reorganization Report. The first is the number $1 trillion, which is a number that's growing, and that's the amount of student loan debt that's circulating throughout the United States. And the reason we view that as a bad thing is because it's finding its way onto the budgets of every household, but as an item that people don't know exactly how to deal with, and the number's ever increasing. That puts a strain on people's monthly budgets, but it also puts a strain on the education system as a whole, because this is how people finance their college educations. It's also how colleges are able to grow and do some amazing things, the research and things that they're able to do with this type of money. The fear is as the debt grows, whether or not the next bad thing, delinquencies, continues to grow. And I'd say of the two, the delinquencies is more concerning than the amount of debt. And that's because as the delinquencies rise, you could see a curtailment in the availability of student loans, or at least an increase in the interest rate. And historically, the lower levels of interest rates available for student loans is what's made them so appealing generally. And if you see that go away, you could have multi-level effects for higher education, for the average consumer, which would be your average college student, and across the board. So those are the big bad figures in the room that we see standing out as a problem.
Interesting. So second, as we look at the multiple things that come up, what does this mean, and what could happen in the future? Who will be hit the hardest if things really do go off the rails?
Well, you have two individual groups that would be hit the hardest. I think your average consumer is the person of student loans, so you have to look out for, and that's what's driving this big number, is you have folks that have student loan debt in the multi-$1,000s across the spectrum, and that debt is very important because it finances college education. If that debt is not available, just strictly as a consumer of debt, not available, then you have the spillover into college education. And that is the college education that you're able to afford now because of student loan debt going to still be there? Because eventually private lenders, when a delinquency level reaches a certain amount, you're going to see what we saw in the credit crisis and what we're still seeing, which is people not lending. And when people don't lend, whether it's as a reaction to the subprime lending crisis in mortgages that we've seen over the past 5 years, what happens? Well, that means that someone can't finance a higher education, and we all lose. So that's the number one thing. It's the consumer of student loans, your average students. The second thing is on the other side of going to colleges themselves and universities, because they rely on the availability of this money to support their programs. We have seen rises in tuition, and there's a lot of data out there that says tuition has been rising because of the availability of money at the student loan level. So you have those issues. And lastly, you have private lenders. And there's a bill being introduced into the Congress in the United States to allow for the dischargeability, which is a big word, in bankruptcy of private student loans. And if that happens, you might see some initial losses for the private lending industry, but the biggest problem will be, most likely, an increase in the interest rates that private lenders charge. So while they may lose in the short term by having their debts discharged in bankruptcy, consumers may lose on the end of the day, so to speak, because of an increase in interest rates. So those are a couple of the what we would call the losers of a bubble burst, but the effects are far-reaching, and we haven't begun to scratch the surface of what it's looking like. But I think people are starting to realize there's a problem, and it's a question of whether or not we're going to deal with it before it bursts.
Definitely. When you describe some of the symptoms with students not being able to pay back loans and then tuition going up because they're not paying back loans and then more loans because the tuition's higher, the symptoms make it sound a lot like a bubble. So it is going to be interesting to watch to see how we address this issue. Again, that was Douglas Bates of Berger, Singerman and the Business Reorganization Report. For more of his commentary, visit businessreorganizationreport.com, and for curated insight from the LexBlog Network's thousands of authors, along with more video interviews, visit us at lxbn.com. Thank you, Doug.
Thank you.